Welcome to TradeTheMBI.com. This is John. This report is for the 6th. And well, we got exactly what we're looking for. Market had started off with the collapse leading from Japan. That raise in rates really affected the carry trade for most people. Don't know, just people borrowing tons of money from another country because they can get it cheap, and then they use it to invest outside of that country for a better return, and arbitrage the difference. It's basically all that is. But once they raised the rates, that forced a liquidation of quite a bit because you had to cover the fact that their margins that they look for are super tiny. And once that took place, that really threw a shift in things. And the secondary item was, in the trade that takes place in prediction of elections suggested that Kamala would win. That throws off what we were talking about before, the market moving into either a Trump version or a Harris version of what the economy would look like, and it just threw things into chaos. And we expected the Fed, though, to throw in huge hidden liquidity to push things back up, and they did. Now, this reminds you a lot of what started to happen in 2007, 2008, as things got a little wobbly. You get these big spike run backs up, everyone thinking everything's going to be okay, only not so much. So it really skyrocketed the odds of recession in that, simply because you have these built-in credit problems throughout the world, and it's not gone away since 2008. It's just been covered up, and it's always been a question of how long they can do it. I think they still have more time, but we'll see. Interesting readings, though, from that. If we go back real quick and look at the ES, you can see the complete collapse taking place here in shorts. They're covering all that situation because they know the Fed. You don't fight the Fed. They could throw unlimited liquidity at the situation to keep things moving for a while. It's just an interesting switch. So you've got pretty strong from an MBI white lead on that, and that could be enough to sustain things. But your shakeout still ugly. Same situation from a DOC standpoint. You got red and that declining. Short-term buyers, could be enough, and that's exactly what has been supporting it. And then, of course, they waited till post-market to kind of like prop things up just enough. And that's all they got to do is just provide enough idea that there's support. NQ, not quite the same, but still heading in the same direction with Magenta leading now. And, you may have seen the bottom tick for that for now. I'm not saying that won't get revisited. I mean, these things usually take days, if not weeks, to flesh out and begin to make their final move. And from a Treasury standpoint, everyone jumped into it, but then realized, oh my God, the Fed's doing, we can buy some, and it caused it to come back down. But this is ridiculous if the Fed isn't cutting, because you're nowhere near this. And you can see those positive extremes are big moves. So people are looking to lose a whole lot of money if the Fed doesn't cut. They're already losing it right now, just being in there. Oil taking its dip, brief, but this projects a broader global slowdown. We'll have to see how that one plays out. This may be more of just one of those artificial pushes where they took advantage of buying into the market on the big dip and then drive the commodity cost down. But they're still sketchy global economic issues taking place, along with the expanding potential of war. I mean, everyone's expecting this Israeli-Iran conflict, and who knows where that leads. And we know the sides that each parties are on, and it could get ugly fast. From a euro that skyrockets, the euro for no good reason. The euro is, the U.S. suffers. The big savings, though, in oil is that flip down, and that changes everything from that standpoint. Gold held up beautifully. Usually you get a lot of selling within that range. Bitcoin in that they stabilized under their key points too. Same with ETH. Back to ETH, small technical issue there with TS. So here you have marked the positive extreme that led to the euphoric breakout that took place way back in the beginning of the year. And essentially we filled that. We're hitting some resistance coming up back to it. So still in a relatively negative view from the MBI reading here, as well as from Shakeout and DOC, all but DOC, you're plummeting into that little reversal area where at least you're going to get some attempt at a spike. But you got to break both the 23% as well as stay above that algo level. That could be challenging. Depends on how much money they fled back into things. You can already see from a 50K standpoint. After the initial dip, they thought back. That was where the Fed providing unlimited liquidity and started buying everything they can. Got it up to the 50% move. Let it fade back to see if there was enough support, and there clearly wasn't. Then they had to redo it again, and they're going to keep doing that to see how many times they can go before they can attract some interest. Because they have to scale out. They can't hold on to it indefinitely. So it's one of those where you try and drive a short momentum move to get out. And if you can't do that, then that's when things get problematic because, they're given X amount and said, hey, drive this stuff back up. And if you can, great, but you've got to generate enough short cover in order to get that going. And with options and then that kind of situation, not so much movement from a liquidity and actual stock situation. So it makes it a little more complicated to kind of do that. And we had this situation, like I was saying, in 2008, and that where you had the market rally significantly, make new highs, only to further implode even bigger. And this really comes down to the question of how tapped out is the consumer? Have they really been pummeled to the point where they can't facilitate new growth? Now, what we're looking at right here is the move pre-market. Huge up. We were up plus 60 some points, and you can see, the residual effect. It's already starting to take place again. We're cut that already in half. I would expect they'll make another run. If we go back to the other day, we can see what happened in that Asian situation right here. In Japan started it, and that just spread and ended up with the big move. And then right before the market opened, the Fed got in there and really provided that liquidity. And as we pointed out, new fund money coming in at the same time. It was, perfect opportunity for them to be able to salvage things. So from all possible scenarios, it was the best timing for something like this to happen. The question is, how much money will go onto the sidelines now because of this and remain in cash? You saw what Buffett and them selling all of, big chunks of their positions in both banking as well as in tech. And the market pays attention to those kinds of things, and they're building up cash. So was their timing perfect? Pretty darn close. So I think there was a recognition of that really caused a significant ripple where people are waking up and seeing that there could be some issues. And again, until there's a more clear political situation, it really poses some interesting dynamics. Before, they were pretty set on a Trump situation, not so much anymore. And that kind of uncertainty is both a sideliner but also added volatility. So we're just going to keep enjoying it. Following the readings has been pretty straightforward. As always, anything relevant, I'll let you know. Have a good one. Trade well.